Um, the Fed's current policy of extremely low, near zero interest rates is certainly helping banks recover in certain ways. I mean, they can use money to recapitalize through buying long-term government bonds. But at the same time, that scenario is discouraging in many ways getting credit out to businesses, to citizens who need it, to the recovery. What's your concern about that, and how do you balance those objectives?
Well, as I've discussed earlier in the testimony, we've seen a lot of improvement in the broad credit markets, in the corporate bond markets, the stock market, and the like, which means that larger firms have pretty good access now to credit, but there's still a big problem for people who are bank dependent, small businesses and consumers and the like. And it's not an easy problem because we don't want to tell banks to make bad loans. We want them to make good loans and loans to creditworthy borrowers. We have, however, done everything we can, or at least we are trying very hard to encourage banks to do that, in particular by telling our examiners, training our examiners to work with banks to take a balanced perspective. That is, we don't want you to make a risky, imprudent loan, but if you have a long-standing relationship with a customer who has been paying, if you have a creditworthy borrower, you should make the loan. It's good for you, it's good for the economy, it's good for the borrower. So we are supporting that with our examination policy, with our guidance. We recently provided some commercial real estate guidance which gave examples for how, say, a small business who wants to borrow against their place of business, and the value of the store has gone down, but they can still make the payments, why that should be considered still a good loan and why you should still make that loan. On top of that, we have certainly pushed the banks to add capital. You know, since our stress tests in the spring, they have been a very big increase in the amount of private capital raised by the banking system. And we have, as you know, increased, supported their funding through the discount window, through and through our efforts to get the securitization market running again, in particular our program to provide investor funds, help investors link up with small business lenders, credit card, and other consumer-type loans. So we're attacking this from a number of dimensions. We're not where we want to be, but we are seeing some improvement, expect things to get better as the economy improves.
It seems to me, and it still seems to me, unfortunately, there's a huge disconnect between a lot of the discussions we have here and a lot of the discussions you have and others have at the Fed in terms of trying to, within strong safety and soundness parameters, trying to get credit out the door, and what the regulators down on the ground and folks visiting particular institutions are doing in terms of really moving in exactly the opposite direction by being so cautious in reaction to what's happened in the last year that they're making it virtually impossible for community banks to loan new money. What more can any of us here or the Fed do to bridge that divide?
Well, one useful step that we have taken, for example, in the latest commercial real estate guidance, is to give lots of examples. Here's an example of what a loan might look like, and here are the things you should be looking at. And it helps people concretely to think about how to deal with a loan that may not be perfect but still is worth making. So we are making a very hard effort to do it. We've had a pretty good record of trying to balance the needs of the economy and the needs for safety and soundness.
The Wall Street Journal has criticized you for being part of the mistake of too much liquidity and credit around 2003, 2005, and has doubted that you'll have the ability or the discipline to rein that in at the appropriate time. How do you respond to that criticism?
Well, Senator, there's really two issues. Let me talk about first going forward. Clearly, we have we've put a lot of stimulus in the economy in order to try and get growth back, in order to get jobs created, get credit flowing. But we understand that there's another side to it, and that includes making sure that we keep prices stable, we don't have inflation issues. And even though ideally the financial regulatory system would be the first line of defense against bubbles or other misalignments in asset markets, given that we do not have currently a financial regulatory structure that is really designed to prevent those misalignments, I do think monetary policy has to pay some attention to those issues. And as I mentioned earlier, we are following valuations using standard models and metrics to see if we see anything that is particularly out of line. It's very difficult to know if an asset price is appropriate or not, but we are factoring that into our discussion, as was mentioned in our last minutes. In fact, on the retrospective issue, it remains controversial. My own view is that the conventional wisdom in some quarters that Federal Reserve monetary policy in 2003, 2005 was a principal or major source of the housing bubble. I just don't think the evidence is that clear. There are a lot of very good economists on the other side of that. One example is Robert Shiller, who perhaps the maven of the housing bubble, and his view is that it had more to do with mortgage financing and psychology than it had to do with monetary policy. The Federal Reserve certainly has a responsibility to understand the role of monetary policy in bubbles and to think about how we can identify those, as difficult as it is, and to try and take that into consideration where we can in making monetary policy.
Okay. In terms of regulatory reform, and in particular resolution authority that we're considering, if we have an appropriate, in your mind, resolution regime, new resolution regime otherwise, would you support taking away 13.3 and other type authority to send taxpayer dollars to specific firms?
Yes, I would.
And would there be any subcategory of that sort of authority which would send from either the Fed or other entities to send dollars to individual firms that you think we should accept and retain?
Well, currently, if the FDIC resolves a failing bank, there may be rare circumstances under which the Fed would assist by providing short-term liquidity to the bank as part of the resolution process. So it's conceivable, and I'm not saying it has to be that way, but it's conceivable that in the resolution authority there might be provisions under certain circumstances where the Fed would lend on a short-term collateralized basis to the entity. But that's a decision for Congress to make. You want to figure out the best way to structure the resolution authority. I think that if the resolution authority is there, though, to go back to your original question, the Fed does not want to be involved in bailouts. I mean, we got involved in them only because there was not a good legal structure for dealing with these firms. And in the future, we have no interest in doing that. We think there may be some value in having lending programs that apply to the economy generally under emergency circumstances, but not to individual firms.
Okay.